Today we're speaking with Andrew Pancholi, founder of the Market Timing Report and co-author of the best-selling book 0 Hour. Andrew made headlines recently when he precisely predicted the February 2025 market top that caught Wall Street by surprise. Now, he does have a record of accurately predicting events including the 2020 pandemic, the 2022 market top, and more recently the Ukraine-Russia conflict and the Israel-Hamas conflict. He predicted the 2020 pandemic back in 2018. So my question is, how on earth did you do that when no one else saw it coming?
Pandemics, like a lot of events, fall in set cycles, mathematical patterns. The 100-year cycle replicates across a whole series of events. So we're already aware of the Spanish flu pandemic post-First World War. Actually, it came before the end of the First World War. And the reason it was called Spanish flu was Spain was the only country reporting that it had actually taken place. Every nation was suffering, but because they were in a war footing, they didn't want to admit that their soldiers were kind of depleted in numbers due to illness. So we knew about Spanish flu. But if you take that another rotation back to around about 1819, 1820, what we saw then was the first cholera pandemic. And that started in Asia and moved across to Europe. And that literally killed tens of millions of people. So that was a big event. But as I looked into this history, going back another 100 years to 1720, there was a measles pandemic that hit the northeastern part of America. And then prior to that, there was smallpox around about 1620. So this seems to be a reasonable repetition. And the way to test these cycles is to look at the midpoint of these cycles and put in the 50-year points. And, you know, if you go back to the 1620 thing and add 50 years, it takes you to around about 1670. Well, just running up to that point was the plague, you know, in Europe and particularly Britain and so on. So we knew that was coming in. Shorter term cycles trigger these things as well. So that's how the pandemic was predicted, because most people said it was a black swan. You know, these things don't happen these days, but it did come in. Yeah. And also with that, we were seeing the 90-year cycle come in from 1929, and it was just 6 weeks beyond 2019. So the 90 years on from 1929 and the 29 market crash. And hence, as we got to February 2020, there was a market high and a very sharp, strong crash, which I know we recovered within a few weeks. But that was another cycle pattern there that caught the market.
I mean, amazing that pandemics can run in cycles. But how about Ukraine-Russia conflict and Israel-Hamas conflict? How did you do that?
The Israel-Hamas conflict, that was published in our year ahead report in January of that year, and it broke out the first week of October. And the reason being, that was, again, a case of this 100-year cycle. If you go back 50 years, that was when we had a huge escalation in conflict in the Middle East and the Yom Kippur War. So we knew to be on alert. And again, there were smaller subcycles suggesting that. With regards to the Ukraine situation, this is a little bit more complex, but the simple basic cycle there was a 30-year pattern where from the breakup of the Soviet Union, when Gorbachev allowed the whole USSR to break up. And so that was the 30-year cycle coming in there in 2022 from that point. But also, one of the things that we've been writing about is that there is a war cycle that comes in, which is around about 82 to 84 years. And what we've seen with Ukraine is that it's actually a proxy war. At one point, I think there were over 50 countries supplying munitions and resources to Ukraine to fight this battle. So again, it was a coincidence of a bigger cycle, you know, the 82 to 84-year war cycle. And if you would play that back, you'd see that, you know, that tied up with the beginning of the Second World War. And then you can take that back again, and you'll see it ties up with other conflicts and like the Crimean War and then the Revolutionary War taking it back. Because each of these major conflicts sees the key players of the time involved. You know, like the Crimean War was an interesting one because it was involving Russia, the Ottoman Empire, France and Britain. Okay, so these countries that were the main players of the time then. And of course, the outbreak of the Second World War, which was, you know, in that next point of the cycle, so many different countries got involved in that. So it's by putting these cycles together that we can see patterns unfold in geopolitics and in markets.
We just had a bit of geopolitical stuff there, but I think listeners are going to be probably more interested in the markets. So let's look at your February 2025 forecast. When exactly did you make that, and how did you reach that conclusion?
We've been talking about these super long-term cycles, but we can break them down into lesser cycles, and we can use these to fine-tune things all the way down to an individual day as well. And what we saw is, as we approached November, December 2024, a whole series of long-term cycles were coming together, and that suggested that we were approaching a major high. Now, you have to put us into the background of what was going on in November 2024, which is Trump had just won the election, and everybody was very, very bullish indeed. Remember, the stock market was going to the moon. What did he say previously? Judge my work by the stock market, yeah?
Yeah.
So people were coming in with the same view, but the cycles were suggesting that we were approaching a major turning point. And if we were to look at that, then using some technical bits and pieces that we teach in our courses as well. So we were approaching a major price target that was coming in over December, January, and we should be on alert from that from November. So that was the first thing. We had the bigger cycles, and we also had some price projection targets. So as these came together, we knew that we were in the window of something bigger. But when we looked at the smaller cycles, we knew that this was going to actually trigger a potential sharp sell-off. In fact, we're so confident about this that we called a masterclass. In fact, we started talking about it between Christmas and New Year. We interrupted the breaks to say, actually, there's a big top coming in. Preserve your capital and get ready. And an interesting point is that actually was 5 years. So 5 years to the day anniversary of what happened during the pandemic sell-off.
And this all related to the Trump tariffs?
Yeah. So here's the big story that gave us the additional confidence was tariffs are no new thing in America, but a very similar thing took place 135 years ago. Well, what's this cycle? It's 3 lots of 45 years, all right, the 90-year cycle. President McKinley brought in tariffs. And what happened? The market dumped, okay, and this is how history repeats. Prices for farmers went up, the cost of a tractor went up 6-fold. The American economy was brought to its knees by these tariffs, of protectionist tariffs. And interestingly enough, it also led to the foundation of a new third political party called the Populist Party. So if history repeats, that's something that you need to be aware of.
So that's almost unbelievable. If we look at what we've just had,
yeah.
So we've had all the turmoil in the markets. We've had the economy will America now go into a recession because of Trump tariffs, and then we've also got Elon Musk splitting off from Trump, saying 80% of people want another political party.
Well, this is exactly it. So I think, the question you asked about calling the top, the time cycle's in, the price was there, it was all coming together, and that extra knowledge, which we'd already put out to our subscribers, we'd said, watch out, because this is what tariffs did, when America was hit with tariffs last time. It wasn't good news, and a lot of the people, my friends who are ardent Trump followers were saying, well, this is going to be great. We're going to have booming internal domestic markets. No, the opposite happened. So we knew that historically. And of course, exactly what you said as we move down the road, Musk is calling for a third party. Well, I can also tell you that President McKinley lost the midterms big time. So I think unless there's a war that's going to save President Trump, I think there's a big threat there economically to the Republican Party as we approach the midterms.
And what's the timing for you? What are the key dates for China coming up?
Well, we've just hit the 90-year anniversary of the Long March, which was in 1934, culminated in 1935. We saw, it was led by Mao Zedong and the rise of the present Chinese Communist Party. So that suggests that China's at a major turning point now. I think it does show that China has established itself. I know a lot of people think, well, the Chinese economy is internally very limited and not strong. And of course, Trump is trying to hit China with the tariffs. But I think the threats to the American cycles for the American empire, especially with the 250-year cycle, are greater than the challenges that China's facing. So on a relative basis, I think China is going to fare better. So the products that China will not be able to sell to America or will have to sell at huge tariffs. I think it's now finding alternative markets. Whilst America had been broiled in Gulf War I, Gulf War II, Desert Storm, everything, China did expand through Africa and South America. And, the American sort of plan of expansion and so on, as we're seeing right now in the Middle Eastern crisis, going in there and trying to take control of the resources and placing American companies to benefit from that sort of stuff. The Chinese have also got an expansionist plan. Originally, it was the Belt and Road, but it's expanding into something much, much bigger. And of course, the Chinese do something similar as well. And all these big countries dump debt on these smaller nations. But the Chinese have also been putting infrastructure in schooling and hospitals and roads for the local people. So it's not all about taking everything out of there. So the point is really that the Chinese, in the Western world, well, everybody wants to back America in the West, but there's a lot of countries throughout the world, especially South America and in Africa, that are actually quite happy to be friendly with China and grow. And what's the big thing? Well, BRICS. Look how many countries are flooding into the BRICS nations. That's all part of this thing. Maybe this is part of the this is part of the end of the American empire as it was. There's another big organization put together. People say, oh, it's different languages, it's different currencies, it's different this, it's different that. But they are getting together. And a lot of the former enemy states of the West are falling into that organization.
Some of the cycle patterns that led you to the correct call. Are there any others that you haven't told us about that were also factored in that conversation?
We've got the long-term cycles, and then we've got the medium and short-term cycles. And the medium and short-term cycles become proprietary, really, because the stuff we use that I haven't seen anybody else write about. Say you go into your local cafe once a week on a Thursday, right?
Sure.
And I join you once a month on that Thursday. Then you're there every week, but every 4 weeks, I'm with you.
Yeah.
And then let's say one of our pals like Paul comes in, and he comes in every 6 months, right, on a Thursday. Then, you're in every week. You and I are in once a month. But then every 6 months, that's when the party is, when the three of us are together. So when 3 sets of cycles come together, we actually use more than 3 sets. But where we do see them all come together, as we saw in the 2020 top, as we saw in that February 2025 top, and indeed the 2022 top, and the lows as well subsequently, when they come together, to prepare. Now, we never know for sure what the market's doing. It's all about getting the odds on your side. So what I really say is that this gives you an idea of when something might happen, but you've still got to follow your own systems and risk management. It just gives you that extra incremental advantage, though.
And that's it. I'm really glad you mentioned that, because I know that you've got this extraordinary background as a senior wide-bodied jet pilot, but also a training instructor and assessor. And I just wonder if you can talk to us about how someone with that experience approaches risk management, and then ultimately how you bring that to your market timing approach.
I've followed 2 careers, one in economics and markets, and I've been lucky enough to have a second parallel career. How we do things so rigorously in flying, and yet in trading and investing, it's almost the opposite. And certainly when you look at retail people, 95% of people are out of business within 6 to 9 months. They've blown their accounts up. But then, as I've been working in the city as well for over 30 years, I noticed that actually there are practically no fund managers that deliver positive results consistently over a time period of greater than 5 years. Now, that's really quite something. There are really only a handful of really well-known names that can do that. But I know a lot of pilots, and every one of them has the same number of landings as takeoffs. But why has one profession got 100% accuracy rate, and why has another one got like a 5% success rate? And what can we learn from one and put to the other? And then the other analogy I give, which is this thing called situational awareness. The next question I ask, right, is how many of you have been on a plane? First of all, everybody raises their hands on that. How many of you have been on a plane not knowing where it's going or where you're going to get off? And of course, everybody falls about laughing. But the same thing is now, let me ask you another question. Have you ever taken a position or a trade not knowing where you're going to get out? All right, or how you're going to manage the risk? And of course, a lot of people will put their hands up. Situational awareness is knowing where you're heading. If you're flying a big jet from, say, London to New York, well, you're going to know what the weather's like at New York. You're going to know what the diversion alternate's like. You're going to know what the facilities are like. But also when you're en route, you're going to know what the weather's like at, say, Iceland or Greenland or the Azores if you've got a southerly routing in Ireland. So you know where you've got a contingency plan. And then the shorter term contingencies are things like, well, there's a thunderstorm up ahead. Now, you can't go through a thunderstorm in a big jet, so which way do you turn? And you have to make that decision instantaneously. But the same thing is, well, when you get a trade on, especially fundamental traders, well, that's it. It's obviously Trump's in, the market's going to the moon, or this is happening to interest rates, or this is happening in the pharmaceutical sector, or oil's going to do this, and so on. But what is the big picture? What is your situational awareness? What are the other factors that could disrupt this trading campaign or this portfolio management model that you're running? How much of that information do you bring in, and do you know where to find it? If you've got a position and you know there's a major cycle coming in, you might want to take profits, hedge it, or protect it. Bringing in risk management in small incremental gains. There's nothing magic here. You can't just say, that's going to be a high, that's going to be a low, and so on. One example, the Ukraine invasion one, oil went up to $128. But what was the news? The news was it's going to hit 200. It's going to hit 200. Russia's going to squeeze the world on oil. And in fact, it didn't. And it hit 128 on a day that we had a major time cycle. And actually, that was a major price target as well. So knowing this stuff really gives you an advantage.
We've just spoken there really so much about the professional, the wide-bodied jet type investor, of the institutional guys, even governments. I know you've spoken to those. How do you then help the smaller investor? How do you help them improve their risk management and their safety record?
Well, it's all about creating systems and awareness. Pilots, right from day one, if you're flying a light aircraft all the way up to flying the largest wide-bodied jets, everybody uses checklists. Now, obviously, at the top end, there's a huge amount of rigor in those checklists, and there are built-in systems. In trading and investing, if you're coming in at the entry level of trading and investing, then have a plan, have a set of checks. You're never going to get into a trade without knowing at what point you're going to be able to make the decision that trade or that campaign is wrong. And this doesn't just apply to retail traders, it applies to the hedge funds as well. How are you going to protect it? Well, if you're a retail new trader, then you're going to use a stop loss more likely. If you're a hedge fund, then you're going to look at hedging strategies and all sorts of more complex opportunities that lie there where you've got a lot more resources and capital available. And so it's just about these ideas of having rigor, having an idea of where to get out. And so one of the things we created, and I've used it very successfully in the funds I've managed, the ability to ascertain clear, potentially very accurate targets for exiting positions. And therefore, you know where to get in, you know where your stop loss or equivalent hedging point is going to be, and you know where to get out. And therefore, you can create a risk-reward ratio. And this is exactly what we teach in our trading courses.
Yeah.
So with a risk-reward ratio, you've now got the odds on your side.
People listening, they're going to see that you really know your cycles. So I guess it'll come as no surprise that you're on the board of the Foundation for the Study of Cycles, which I was surprised to know that was set up by the 1941 US presidency.
That's absolutely right. By 1941, America, and in fact the Western world, had lived through the Great Depression. And what President Roosevelt wanted to do was to see if that recession and depression could have been forecast, if it could have been dealt with in a different way, because he spoke to the chief economist there, Edward Dewey, and they created the Foundation for the Study of Cycles, and the key purpose was to see if these recessions and depressions could have been forecast. That particular one, in 1929, if you go back 90 years to 1837, well, you go back to 1839, but 1837 to 1842, so a 5-year decline in the markets, and that was all to do with the drying up of credit following the policies of Andrew Jackson. And what had happened was that in the Midwest, credit had become very cheap and easy. And there was a huge expansion around the Chicago area in the canals and also house building, home building, because, as I say, credit was cheap. So the idea was that the crops, particularly corn and wheat, soybeans weren't really about then, you were able to ship these into the Great Lakes and up the St. Lawrence Seaway and out into the rest of the world. That credit dried up very rapidly, and it created this massive boom and bust there from 1837 to 1842. And if you project that forward 90 years from that midpoint, that gave you 1929. And to be quite honest, you'd have had to have been on alert from 1927. If you take 1929 and add 90 years, 2019 was a key point to be aware for a potential crash or major turn. And that came in just 6 weeks later. Well, 6 weeks in a 90-year cycle is something that's quite minimal, as it was well within the torrents, and that's when we saw the pandemic sell-off. But the other thing about 1929 is that there is a 72-year cycle. But if you head back from 1929, 72 years to 1857, what we saw there was a railroad boom collapse in both Europe and in America. That was the primary thing that was funding the boom up to that point. And what happened was, I think it was September, October 1857, the Ohio Life Trust in Cincinnati collapsed, and it was just loaded up with railroad bonds. But take 1857, add 72 years, you get 1929. Now, add another 72 years to 1929, that takes us to 2001. And I was actually advising one of the largest funds, a very well-known billionaire, I have a non-disclosure, I can't tell you who he is. And we were looking at these very same patterns back in the late 90s. And that's when we were seeing the dot-com boom, all right? The dot-com boom is another interesting one. And we knew that that was probably going to pop by 2000, 2001. Of course, we project that forward to 2073. So probably not too good for you and me, Jonathan, but maybe our kids and grandkids can benefit from that one. So coming back to this idea that the foundation for the study of cycles there was set up to see if this work could have been forecast. And it obviously wasn't recognized at the time. As you know, cycles are not the most popular, they're not the most sexy thing, but the foundation is going strong. And in fact, we've just had our very first in-person conference in, I think, over 20 years in New York over the last few weeks. And we had some very big names attend that. And the foundation is back up and running in a very strong way.
Brilliant, brilliant. So what we're seeing then is this combination of mathematical precision and historical pattern recognition. And I can't begin to imagine the amount of sifting you would have had to have done to get all this signal out of the noise of history. So I'm just wondering, what can you share with us about your methodology, obviously without giving away your proprietary system?
Right. I studied economics at university, and the more advanced I got, the more disillusioned I got with it. So once econometrics came in and everything was distilled down to a mathematical formula based on calculus, I suddenly started thinking, well, there's no real touch with the real man here. And I didn't know very much about human behavioral patterns at that point. But that was the first thing that started triggering. But I did notice the K wave, the Kondratiev wave, for example, seemed to work, this 60-year pattern, 55 to 60-year pattern, whatever you want to call it. And I thought that was interesting. So as I went along, I studied a lot more history, and I kept a lot of, and I still do, keep timelines for all sorts of things. And that's the key. So that you asked about the methodology. The key is keeping timelines, and you have to put them in context. So you can look at the history of America, you can look at the history of Britain, you can look at the history of Japan, or whatever. You can look at the history of banking crashes due to the lack of credit, banking crashes due to fraud, all that sort of thing. You know, bubbles and so on, bubbles and manias and panics and so on. And once you put them all within context, and, you know, if you want to look, say, the history between America and Russia, for example, this is the key, this is the secret key to the geopolitical stuff. You put all the events involving those two nations on a timeline as well. So the idea is you spin these out and then you'll see cycles unfolding. And now one of the key things is that a lot of things move in 18 or 18 and a half year cycles. The 100-year cycle and 50-year cycle strong. One of the things we did predict in 2006 was this idea of there was going to be a big crisis in 2007. 100 years back, 1907 Rich Man's Panic, and then 100 years before that, the 1807 Embargo Act. Now, the Embargo Act was a really interesting one because tariffs are very topical at the moment. So in the Embargo Act, the Napoleonic Wars were going on in Europe. So America decided if they embargoed trade with Europe, Europe would come to its knees because they were so reliant on American things that that might not only stop the war, but it would increase American sovereignty globally. Unfortunately, the opposite happened and the market came down 80%. And then 1907, there was no Federal Reserve in 1907. So the government called upon J.P. Morgan himself to help sort the problem out. Well, which was one of the big banks in the middle of the global financial crisis? J.P. Morgan, 100 years later. But the story doesn't stop there, because let's go back to 1807 and remember how we added 50-year patterns in transportation. Add 50 years to 1807 and we get 1857. Now, we've just mentioned that with the railroad boom. So you can see how these cycles are interweaving. Then we've got another 50 years taking us to 1907. And then in 1957, the American markets came off 20 to 25%. There was no panic per se, but that was a secular bear market. And that was because everybody that could afford a refrigerator had one. Everybody that could afford an automobile had one. Everybody that could afford a television had one. So it was a downturn in manufacturing. So it was a bit weaker. So that's the other point to make, is that not every cycle repetition is going to have the same magnitude. But that is how this all comes together.
Brilliant. I recently heard as well that you are now unofficially the sole cataloguer of the W.D. Gann family legacy material. I guess for some of our listeners, if you could just clarify who W.D. Gann is, and also just how that came about.
Several people might not know who W.D. Gann was, and he was a forecaster and trader who, funnily enough, did get the 1929 top. And quite a lot of the work I'm talking about overlays with Gann's work. And it was very successful. He did own an aircraft. He owned amazing cars. He was able to sort of time highs and lows. And of course, markets were far less complex then as well. But he was able to call them. And he used a lot of mathematical patterns. He used a lot of geometry. Some of this stuff we include in our course for trading that we teach people in. The work of W.D. Gann was all in a private collection. And W.D. Gann, he was born in 1878 and he died in 1955. And he had a business partner latterly called Ed Lambert. And this couple, Billy and Nicky Jones, were living up in Washington State. And they'd approached Ed Lambert. And Lambert apparently was a bit cranky. And he said, if you like it so much, come and buy it off me. And this happened in the 1970s. And they went all the way down to Miami. And they did a deal with him, and I know they paid $10,000, which you've got to put that into perspective. That would get you a nice house in that day. And they hired a Mayflower truck, and they drove everything all the way across America up to Pomeroy in Washington State. And if it wasn't for these two people, the Gann work would have been lost, because it was literally going in skips, and people were throwing it away saying it's a bunch of tatty old charts. But there's a lot of stuff there. Now, the problem with Gann's work is he never told you exactly how he did it, or he'd just tell you some basic stuff. And you've got to decipher it and be a detective and work it backwards. Billy Jones taught it in the 70s and 80s, and he passed away in the 1980s. I did strike up a very great friendship with Nicky Jones. And Nicky was basically running the farm. She was bringing up 4 kids whilst Billy was doing all this trading and investing. And I struck up this friendship with her back in the early 90s, and then people wanted Gann stuff in Britain, so I started importing it and put adverts in things like Investors Chronicle. I developed a close relationship, and I'd go out and see her, and she'd show me some of the material. Fast forward, then I think it was 2007. I went out there for a couple of weeks. She said, can you help me out with this? Because I don't really trust anybody else. And we went through it. Nikki, Cody, her son, who's now running the whole business, we went through it bit by bit, and there were trunks of charts there that I said, do you know what's in them? She said, I don't think they've ever been gotten around to being opened. That's it. And we found some incredible stuff in there. Now, more recently, that stuff, I found some very rare papers over my visits. Some of them have been released now more recently and made available. And I've been able, because Nikki didn't really know what the stuff was about. And of course, I'd studied it. So she trusted me to do that. And Cody is now, benefiting from this and doing a great job with it. So that's what happened. I went through all the archives, and there was all sorts of material, not just on markets. He was a very diligent chartist, very precise. But he charted wars, he charted presidential cycles, not just in markets, but also patterns of geopolitics, sunspots, you name it, all sorts of stuff, weather cycles. And it's all there. And a lot of this remains in the private collection. So I was very honoured to be able to look through that stuff with Nikki and Cody, and I'm glad that some of it's out there now. There's still more in the collection as well.
I just wonder if I could ask you to look ahead, and give us some take on what you and your subscribers are focusing on right now as potential events to be aware of.
Short term, the money's in the market, as they say, right? Years ending in 5 tend to be bullish years. Years ending in 7, with the exception of 2017, have seen significant corrections. There's no holy grail, but you can get the odd incremental gain or thing, and you keep stacking them, and then suddenly you make big gains. So in the short term, that's what's going to happen. Yes, there's some cycles over the next few weeks and months that we'll be documenting in the market timing report, where we can be open to pullbacks and be prepared for those. Then, in terms of the bigger roadmap, there's three things I want to bring in. We talked about the 1929 crash. If you had a 100-year cycle, which I think everybody's fully familiar with, to 1929, it's going to take us to 2029. We might well be setting ourselves up for a substantial top up there. So if we know that and work it backwards, it might be that we're in a bigger bull market than people think. If you take the outbreak of World War II in 1939, as it were, and add 90 years to that, then 2029 is going to be the 90-year anniversary of that. Now, this is unusual, thinking back to who's popping into the cafe on Thursdays and every month and every 6 months. So we're seeing a war cycle coinciding with a market cycle in 2029. So now things are getting a little bit more ominous. We're only 4 years down the road from that. So the hedge funds that I talk to, they're kind of looking at this sort of information as well. What we see is that empire cycles last 250 years, okay? Now, the tolerance of an empire cycle can be 250 years, it's 10 years either side if you want to look at it. But what we're seeing is that 2026, 4th of July 2026, will be the 250-year anniversary of the founding of the United States of America, of the signing of the Constitution. 250-year cycles are also sort of death and rebirth cycles for empires. We're not necessarily saying America's going to collapse, but we're going to see significant changes in the prominence of American sovereignty. And we've already been saying it. Let's go back 10 years. What happened in 2016? This is what, when we wrote Zero Hour, we're working on Zero Hour, this whole idea that we're seeing a whole new side of society and world relations, because in 2016 in Britain, Brexit took place, which really impacted all of Europe. In America, we got a new kind of president, the 45th president as he was then. Donald Trump came in, not a statesman, not a career politician, but somebody who was doing things differently. And what could we sum that up? As we entered this window of this 250-year cycle, we were going from globalization to polarization. And what do we see now? We see this idea of competing nations and empires like China and America and so on. And you can see how polarized the whole thing is becoming. Now, that's going to come to a peak next year. So America's now in play as well, big time. And of course, the events of the last few weeks and months, where we see an escalation of war in the Middle East and so on, they're going to have a tremendous impact on how the leadership of sovereignty is going to switch, because I think America could overextend itself in this situation. And then within that, one of our trigger cycles is the 18.6-year cycle. And that is going to see a potential economic peak in 2026-ish, roughly. So what are we seeing? Are we going to see a peak in 26, pull back, and then a carry on up of a bull market? I don't know. There's another factor that's really outside the context of this chat, where that 2029 era might pull forward to 2028. But with regard to that 18.6-year cycle, Jonathan, when we were talking about the pandemic, what we did also see was the inclusion of this 18.6-year cycle acting as a trigger then for the pandemic crash, as it were, or the pandemic setup. So if you take March 2000, right, and take 18.6 years back, or 18 years and 6 months, that exactly gives you 9/11. Which sector collapsed at 9/11? Airlines. Which sector collapsed in the pandemic? Airlines. Point is, that was a cycle trigger for an epidemic or a pandemic. That's the airlines and fear cycles, 9/11, fear, pandemic, fear. But also, really, this epidemic cycle kicked in there as well. So we saw COVID, but if you go back 18.6 years, then you got SARS across the Far East. And if you go back another 18.6 years, we had AIDS, HIV. And if you go back another 18.6 years, then we had Hong Kong flu. So you can see how this shorter 18.6-year cycle triggered the 100-year cycle.
There's a lot of people worried, and so FOMO has been not only fear of missing out, but there also seems to be a fear of having missed out.
Yes.
What's your sense right now in mid-2025 of the opportunities or lack thereof for people coming into the markets today, or thinking, have I missed out on this opportunity?
Right. Well, there's always an opportunity that's been missed out on. retrospectively, right? The point is, what's the next opportunity? So the first point is, at one extreme, the cycles help you reduce FOMO, because if a market's coming down, there's a major cycle point coming up, then we can be looking for, the first thing you do is you trade into the cycle. So if you had been short, then you'd be looking to cover that short and realize your profits, or at least hedge that position. But you don't immediately say, well, that's the cycle, because it could be an acceleration point. You then have to wait for the market to reverse, let the chart pattern tell you that, and use the appropriate geometry to go in to the other side of it. So that's the whole point, is that reduces FOMO, because the other side of FOMO is, well, I was long and I was up so much, and then it pulled back, and then I gave it all back, and then I gave back even more than I put in. So that's profit turning into a loss as well. But that's the FOMO of missing out on an exit point, which the cycles would normally, don't always, but most of the time will identify those.
But you're looking ahead right now. You just think there's still a lot more for this to play out before we get the final peak. Is that what you're saying?
Here's the key point, is that if you know the right techniques to figure out where the right pullbacks are, if it's a bull market or whatever, or even in a bear market, and you can identify the cycle points, and you have the ability to manage the risk, then yes, you can join in these parties quite easily with minimal risk. Yeah, it's just when a move started and then you want to try and manage the position right back from the bottom, and you didn't get in till it was up already 20%, then you've got a lot of risk there, and you're then unable to get a good risk-reward ratio at that point.
If someone had followed your recommendations in your market timing report around the Feb 25 top, how would their investments have compared with people that remain fully invested?
At the time we're recording, we're back at that top. So basically, anybody that remained long, if we were talking about tracking the indices, now flat, having been down substantially during the course of that. The positive side of this is that most of our followers and those who attended the masterclass that we called, having people prepared for that, were able to trade the downside, and then the bottom came in on the next time cycle. They were ready to once they got confirmation, to take the upside as well. But it's all about getting the odds on our side. So yeah, if you've been following the market timing, your portfolios would have increased substantially.
In terms of protecting yourself from downward shifts, what can the average investor, or a retail investor rather than a professional investor, do to protect themselves from these kinds of shifts?
If you know something's coming up, you can protect yourself there. And, first you protect, then you harness that opportunity to be able to capture the move to the other side. But you have to let the market prove it's going to do that.
Yeah.
So I'm not saying it's easy, but it is very doable, and that's what we do.
If someone wanted to access your recommendations and your reports, how would they go about that?
First of all, go to markettimingreport.com. That's where everything is. The core product is the monthly market timing report, in which we look at the time cycles on the S&P, crude oil, gold, dollar index, euro, and Bitcoin. But I also put my geopolitical thoughts in there as well, so there's an editorial as well each month. If we see anything big coming up, we'll do a special report. It's all about the histogram system, this timing system. And when we get a big spike, everybody's in, and that's when we can expect a potential reversal, so we can be prepared for it. The market timing report's probably been about 10 years now. But before that, we were just providing this information to hedge funds because we were just doing very well. So I was doing very well trading this information myself, having programmed it and created it. And then people said, well, we want a more affordable version. And that's why we created the report. So, it's there for everybody now. Everybody can access that. Then we found, working with partners and friends, that people were coming in with less trading knowledge. So a hedge fund was like, okay, there's a big cycle date coming at this point. We put that as 5% of our decision-making process, maybe 10%, along with everything else. But then we got retail investors coming in saying, I don't know how to use this information. So, of course, this is information that you have to apply. And remember, we talked about having checklists and plans. And so I published my trading course that I've used, which we very successfully ran a hedge fund with. In fact, last year we beat the S&P. We were up 34%, beating the S&P by 48% the last year we operated that fund. And that's using these very same techniques. And we made it very affordable. So that's the Market Timing Report trading course for those people who don't have a system. And the important thing about that is to be able to identify a trade, identify the risk points, the entry points and exit points, and create, very favorable risk-reward ratios. So if we go back to this idea of, you're getting on a plane, you know where it's going, and you know where the contingencies are as well if there's a problem with an engine. So that's the market timing report trading course. And in there, we've also got techniques, some of which are based on GAN, which show you how to forecast the final price level in a move and things like that. And that's stuff that I hadn't said. GAN never wrote it explicitly, but I discovered it through looking through the work. Then we've got people who want to trade more regularly, and we've got a seasonality module that we released in the last few months, which has AI in it. And what we've done is we've taken this to a different level where, again, we look at a whole series of different instruments, stocks, FX, commodities, and we look at the highest probability trades. And just taking those trades alone generates potential returns of 67 to 68%, but you've got to be able to manage the risk. So there's a big caveat on that. And then now, at the time we're recording this interview, we're just about to introduce an investing module for stocks only, for the stocks, but the stocks can be US, American, Australian, Indian, we've got a few different countries there. So they're kind of where you can do a longer buy and hold, or the opposite of that if you were selling short. And then my favorite thing is what we call the Master Traders Course and Professional Platform. And in that, we look at the commitment of traders data and we take a deep dive into that. And that shows us which markets are about to move. And the challenge with commitment of traders data is, well, you know it's going to move, but it's going to move this week, next week, or in 2 months' time. Well, again, with the timing system, you know, and the market timing report, those instruments, you can then trade very accurately with that. And that enables us to capture the big moves. We can see when Bitcoin is about to move there with the data, when oil, wheat, corn, you name it, sugar, all these things are in there. The dollar, Aussie dollar, you know, all that sort of stuff. It's in there. And I'm really pleased with that because that's where the big money's made in the longer moves. We also provide with some of the major turning points for the currencies as well. Farmers, we've got a lot of farmers, so we give them the timing points on grains, soybeans, wheat and corn. And then finally, there's the consultancy directly with myself and my team, where we talk to hedge funds and actually individual traders as well, and help them out with the timing and whatever they want, really. So that's that there. But that's all at markettimingreport.com.
If an individual trader wanted the kind of help you would give a hedge fund, what kind of funds would they need to have in the markets for it to be worthwhile?
Well, that's a really good question. What we found is the Market Timing Report trading course, which sells for $2,995, is a very affordable product and far surpasses people selling things for 10 times that amount. In fact, the reason we put it out there at that price was we did actually hold it in person over 3 days, and people paid £25,000 a head to attend that. And they've all become very successful traders. In fact, one of the guys, a dentist, has retired from dentistry just using one of the techniques from that. That was my own methodology that worked. It's the best of, you know, everything I've studied for over 30 years, and I put the very best in there. So $3,000 would educate them, and then the report is $149 a month. You know, if you want to go month by month, it's only 3 S&P points. And of course, there are deals for longer subscriptions. So that's the entry level cost, really, is $149 a month. And then if you don't know how to trade, then the course is there. And we've sold literally hundreds of those with a lot of very satisfied customers.
If I was starting out, and I'm seeing that what you've just described as, so we've got a possibly a really good year in 25 with a very strong sell-off potential in 27. So if I wanted to get into the markets and follow your safer trading system, what are my options and how do I work with you? So let's just say I'm a relatively experienced individual investor.
Yeah.
Right. How much do I need to have in the markets I'll be planning to invest to warrant having your coaching with you and your team directly the way that you would work with a hedge fund?
So it depends what you want. Some hedge funds will pay a lot of money and just want one call a month. I've got somebody that just wants a call every 2 months, but they pay quite a premium for that call because those calls make them literally hundreds of millions because they're looking for the trending markets, all the way down to individual traders. I mean, what I would say is the courses we provide, you can get everything there if you're prepared to self-study. We do masterclasses probably once or twice a year. Typically, you need to have the course to attend that, or you can buy the course and attend it. So that's the $3,000, and we might charge $1,000 if you've already got the course. So that gets you in front of me in a live environment. And then the coaching really varies depending on the individual person, but typically $15,000 a quarter is what we charge for fortnightly calls and so on. And we work on projects together and look at stuff there together to enhance trading and investing.
Okay, so what we're looking at, I guess, would be if you've got you've got a decent, or rather quite a significant portfolio to invest and to keep investing, or you're willing to invest in your future, and so you can make sure you get your education sorted this year, so you're ready for all to come next year. And I guess you'd be keeping your subscription going to make sure I'm getting your wisdom ongoing.
Well, that's it. And of course, the coaching's there really for people that really do want to handle it. There's plenty. We've got very, very successful people just buying the products that are available.
Yeah.
And even just the report itself.
So if you're offering one piece of advice to investors watching today, what would it be?
Markets repeat. There is no new thing under the sun. When somebody says on Wall Street, this time it's different, be aware. Sentiment will kill you. If everybody's going long Bitcoin or everybody's going short this or the other, look for the cycles, because that's where you'll see the truth. Because remember, markets move slowly, and then the public tend to come in the last phase of a blow-off move, right? So on the upside. So they're always caught in the last bit and then lose the money when the market sells off sharply. And it's, of course, the last bit where the smart money is getting out. Summing it all up, have a system that works for you, okay? Whether you're a day trader, now, we're not really big on day trading, but our course does work on day trading in terms of the entry-exit techniques and levels. But have a plan. And the best and easiest money is made whilst you're relaxing. So if you have a plan and you enter a position, put your orders in for an exit and also the stop losses, switch your computer off. You don't need to be sitting at a computer all day in front of a trading screen. I probably only look at our trades probably 2 or 3 times a week, if that, because it's all planned and we know what's coming up ahead and so on. And that's the whole idea. Make it easy for yourself. There is no holy grail. It's all about incremental gains. And the better the situational awareness you have, the more successful you're going to be.
On that note, thanks very much for your time. Look forward to speaking to you again.
Thank you, Jonathan.